Okay, I haven't made many videos lately. It's this weird thing. Who cares? I don't make a penny from making my videos, and why would I care about it? But I feel like I've missed it. Now, I am still here, and the reason I haven't made my many videos is I have been working a lot on some corporate modeling issues. Some people, I think, if they ever run into me, may see that I do a lot of project finance and I get obsessed about things like resolving circular references and making multiple issues sculpting and all that. But I'm obsessed with just general finance and corporate finance. So on this file, I'm gonna on this file on this menu, I'm going to go through some of my ideas. I'm going to try to do it primarily in a PowerPoint slide that I put here. And I'm going to, ooh, I put this a little in the wrong place. I'm going to show you this nightmare that I've been having, and that is an issue of getting data. And I suppose I'll open a file. See, MarketWatch and Yahoo used to allow you to retrieve data. Now, if you get data from these files, unfortunately, the first thing you have to do is click on this, and oh no, and then once you click on it, you and download it, you go into the properties, and because the files have macros in the properties, you have to press this unblock. And I promise you, if you're afraid to open a file with macros, well, I can't do anything about that. Okay, and it looks like I have another second. Now, in these files, here's what happens, and I'm just going to tell you what happened. I developed over many years a system that nobody really used, I don't think, very much, which I'm sad about, where you could put ticker symbols in, get financial information, stock price information on, oh God, I'm using my hands like some politician, uh, uh, where you could get both financial statement data, and I got that from MarketWatch. Now you can't get it from MarketWatch anymore. You go all over the place to get financial information using a tool I would use, which is just in Excel, scraping the internet a little with workbooks.open and a macro. I couldn't get that anymore. Then I went to finance.yahoo, and something got changed, and it's really, really slow. So I had to come up with another method, which I'll show you. And in this case, I just realized I didn't open the file I wanted to, and I'm going to pause again. So here's how this file works. Excuse me. This time I kept things simple. I download the files, and when you download the files, here's what you can get. You can get a variety. In this case, I selected energy companies, but in other cases, I selected general companies. In some cases, I selected only utility companies, so we can click on a energy company, for example, here. And then once you get this file, you notice that it takes a little time to recalculate, and that's because some of the mechanics I used. And here's this company. We can go back much further now. So when finance.yahoo and MarketWatch were so mean, what it allows you is rethink the way you've done things before. So in this case, no, it's taking a second to redo, but I'm getting all of the data and getting all of the history, and you can kind of see what happened in these periods. The company made a whole lot of money because they were using merchant prices. Then they decided to become a really boring company over here, and they got a low cost of capital. And we can look at the stock price, and we can look at the IRR and the stock price, the beta. We can look at the EV to EBITDA ratio, what makes that EV to EBITDA ratio move. You see we have dramatic differences, and just claiming you can have one number for one company or one industry is crazy. We can also look at the PE ratio and look at how that compares to the return on equity and the share price. We can look at some history of what happened to their sales growth, and we can look at some debt statistics, and we can look at these for different periods. And most importantly, then we can compare companies. And not only that, so now I'm changing the time scale again for this company. And what I'm going to do in this video, just to give you an introduction, I'm using this. What happens is some of the old data that you get from Yahoo on the financial statements is not quite as good, but it's still pretty good. You can see what happened to their interest rates. You can see what happened to some selected numbers and other issues. Okay, so that's just a little introduction. Let's compare that to perhaps an oil company, and in a minute, then also compare that to electric distribution company. And I'm keeping modifying kind of this, and I go crazy with this, and I'm going to discuss in this video some of the implications of all of this. So this is a boring company. We're going to really focus on the price to book ratio and the returns, and some of the statistic. You can see the beta on Exxon is pretty low, but they have wildly volatile earnings compared to maybe this really boring company that really rips you off. I hope there's nobody from company watching the video, but they have very high electricity prices relative to their costs, so they're able to earn a high return, and you can see all this is all kind of boring, and they produce a market value that's a lot higher than the amount of equity that they've invested in the company. That's the price to book ratio, and it's a key measure of performance. So I've tried to select a relevant kind of graphs, and when I have worked on this before, I try to do too many statistics and get a little too fancy. All right, that's an introduction to this program. And if you would like this program, I'm still in the midst of kind of making it have automatic downloads, but on my website, I'm including instructions how to get your own companies and get your own database and do some comparisons. So let's just talk about a few issues here. Okay, here's what I want to talk about in this video. I'm going to go through some fundamentals of corporate valuation, and I want to be a little provocative and tell you how much I despise two things. Number one is the McKinsey book of corporate valuation, which I think is just worshiping monopoly profits and doesn't really say much about some of the nuances and essence of valuation. And the second thing is these academics who really are driving me crazy. And then we'll talk about how you can very, very quickly make your own little model and simulate things like the price to earnings ratio, the price to book ratio, understand cost of capital much better. And then we'll talk about terminal values and some other things. I'm not going to go through part 4, which is the detailed construction of a model. Okay, and here's some of my, I've already kind of gone through this. I believe more than ever this CAPM just doesn't do anything. The question is, what can we replace it with? How can we really estimate the cost of capital? I believe, and I have tried to come up with elegant terminal value formulas, but we need to start with philosophy before we get into this. And then we've got to understand just the implications from an economy-wide standpoint and for a company. How long can you continue earning returns way above your cost of capital, realizing these economic rents? Maybe forever. I'm not saying you can't. And then we'll talk about the problems with measuring returns themselves, because I emphasize in the first part returns, but then we want to show problems with the returns. Let me see if I can get through to a little more quickly. I've just told you, don't be afraid to restart. Don't get attached to old models and just try to fix them. That's the mistake I made. That's why I made a video in a little while. Okay, and try to come up, if some new tools become available, try to really use them. Okay, and then I think reviewing other people's model and stealing stuff is great. Don't follow bureaucratic rules. Now, if we start right at the beginning, and this is the problem I had, and I've monitored University of Chicago classes, and I found just how bad some of them were, because they get into really fancy stuff. They don't understand that the very first thing you do is understand every single valuation problem comes down to 2 things. What's the future cash flow, and what's the risk of those future cash flows? That's all we have to do, is forecast cash flows and then forecast the risk. Now I'm using this program I showed. So here I picked Tesla, for example. Okay, you might have thought, oh, Tesla, Elon Musk, Mr. Elon Musk, he's going to keep growing like this. Well, what happened? It suddenly tailed off, and the margin suddenly came down. They were making such a high margin, the price must have come down a little from competition, and then the price fell. How are you going to make a forecast of the EBITDA margin, the sales, the net income? How are you going to make a forecast of that in the future? Now, talking about new tools, let me see if I can do that here. I have a friend named, now I hope he's my friend, named Brian. If I want to make, let's say I want to make a 500-year forecast, that's crazy. What an idiot. But that's what terminal value is all about. And if I put equal sequence here, and if I go put a comma and go up here, I can get a number that goes all the way to 500. And then if I've got, so let's just make this our time period, okay? And if I have I want basically my problem in, okay, I'll make that wider. This silly things, excuse me. If I want to make this, come on. If I want to make a historic period and then forecast forever, which is what we're doing in finance, I'll put a historic period. And I'm just trying to show you here, let's say that that's 5 years of history. Let's say it's, 5 years. We can just go up here and put less than, but when you go up here and then you put a hash, and then you put a less than sign, and then you get a little flag immediately. And then if you want to put historic cash flow, let's make it a little random. Let's say it goes from 100 to 300. And let's say, so it's a little bit random. And if you put rand array, now, I didn't know this, and let's make 500 years here. and then let's say it starts at this and ends at this. And what you're, just a minute, rand array starts at this. Sorry, rows. We don't have any rows. See, I get this stuff wrong a lot of times, all the time. Okay, and then we get a random number, and then we can take that random number and multiply it by this little true and put a little hash. Now you can only put that hash there if you've used this thing called the dynamic array already. So we can put that, and we can put projected period, okay, and let's just say the projected, just put equal NOT of this one, and again you put a hash and you get it to go all the way, and then projected flag or something. Okay, I should be putting more units in and doing all fancy stuff, and projected cash flow, and let's say we're just going to make a 150 cash flow, but we have a whole lot of risk associated with that, so we just could take this number hash and multiply it by this. I hope we can. Okay, and then we get the future, and then we can make a little graph. And when we make a graph, let's make this graph for 10 years. So we'll put 5 years of history and 5 years of forecast. And the first thing let's do is we'll put a little if, and go up to this number here, and press my hash, and if this is less than 10, then we use that number, okay, and put another hash. Otherwise we put NA, open and close the bracket, okay, and then you can make a little less than or equal to, excuse me, and we could make a little historic and projected, okay? And the history, we could just take this number and put a hash on there. And that, what I'm trying to say is with this, sorry about not doing this very well and getting a little bit off track, what we can do is, I suppose I'll have to do it like this. I'm going to make a little graph with alternate and F1, oops, and then when we make our graph, we'll change the axis and make it a date axis. Now my friend Brian says do it a little bit differently, but that's just a little bit of I think a couple of important tools, and just illustrating how this dynamic array works just a little bit. Now, I'm not at all a fan of these dynamic arrays necessarily, because they cannot do a lot, but just to kind of really introduce some of the things we'll go through. So that's a little bit of a further example. Now, all of these files that you will see, I don't want to open my but I'm going to have to open my emails for just a second. Here, all of these files that you will see are on this corporate modeling and valuation, and I pressed the wrong thing. Okay, this top one, and the exercises have all of these. So let's go through some finance theory, and I really wanted to focus much more on the finance theory. Maybe I'll do it. Maybe I'll have to make a separate video just on finance theory. But for me, it all starts with this basic, horrible kind of consultant diagram, where if you have a good strategy, you can get a high return, and if you get a high return above your cost of capital and grow the company, you get a high value. I don't know why they're double circles here. So you start with a good strategy, you try to make people addicted to your product, like if you're McDonald's or Starbucks or Disney or Apple, you say, you can only have this, and then we can charge a high price for our product and get a high value. Okay, that's thing. And if you go a little further, we can make a little graph where this is your return, this is your cost of capital. If you make more than your cost of capital and grow, you always want to be here. I argue this might be the worst place to be in some sense. Because you're going to earn a high return and grow. The problem is everybody's going to try to copy you. The worst place to be is this one, where you have high growth and you're throwing money away. This is worse than this, where you just kind of going slowly and being a nice boring. No, this is you better exit the business if you're growing slowly. This is the good thing to do. Get out of the business. This is when you become a boring company. It might be the best. That might be the best. Now, I do not understand. So much of what I learned comes from students and not reading articles, not reading books. One student I had who went to Manchester, a University of Manchester, was brilliant kind of. He said, let's do all these equations. We start with, if you have a savings account, if you have a bunch of money in your savings, you can do two things. You can leave your money in and let it grow, or you can take your money out and buy a bunch of shit, crap, good stuff, okay? That's what you can do. So the way you grow money is to get a high return on investment and save 100% of it. Then you get a high return, it grows, and then that's the same as our basic formula that says take the return on equity and 1 minus the payout ratio, and I'm calling this a dividend payout ratio. That's the start of all valuation formulas. The second one is just an integral formula that says I have some cash flow to start with, and I divide that by the cost of capital I earn minus the growth rate. That gives me a high valuation. That's just basically the NPV formula forever, integrated. You take these two formulas, they're not that hard, and then you adjust this one, and you say, let's take the growth divided by the ROE, that gives me 1 minus the payout ratio. Let's figure out what the payout ratio, that's 1 minus the growth rate divided by the ROE. We'll substitute value here. Dividends are earnings times the dividend payout ratio, so we put earnings, kind of like a price to earnings ratio, and then we divide that by K minus G, but let's substitute the dividend payout ratio, and we take the earnings 1 plus the growth rate divided by the ROE. That gives you the value. It's not a hard formula to derive, is it? It's amazing that this McKinsey book, who emphasizes this formula, can't start with some basic mathematics like that. Now, you can take that formula and just make a whole bunch of adjustments to this, and that's what this man, I can't remember his name, told me from Manchester. You can take the price to earnings, 1 minus G over ROE. You can reverse it and get the cost of capital, earnings to price, not price to earnings, times 1 minus G. You can do this, and instead of using ROE, you use return on invested capital, including the debt plus the equity. And then if you use invested capital of debt and equity, you have to use the blended average of debt and equity rates. We'll talk about why this is such a ridiculous thing a little bit later. And you can do the whole thing with the invested capital, and you can find the price to book ratio, which is a ratio that I think is so important. It measures the price and the value of a stock today relative to the book value, and the book value is not some stupid little accounting thing. The book value of equity measures how much money equity holders have put into the company. And you put money in just like you put money into your savings account. You put money into your company either by putting paid in capital, that's where you directly put it in, or you put it in by not taking a dividend. That's like your savings account we talked about before. And if your market value is higher than the amount you invested, you've done something good with your investment, good in terms of ripping people off maybe or whatever, but good in terms of an investor. If this price to book ratio is lower and the price is less than the book value, the price of the share that is, then you've done something bad. Well, from the investor standpoint. And that's what I say here, okay? And that's such a basic concept. And for me, that makes the price to the book value really important. Now you can take these files. I'm going to try to not do too much Excel here. You can take what we've done up here, where we just started our little model, and you can make a 500-year model. And in this 500-year model, what you can do is you can say, okay, first prove this formula. Prove this formula that 1 divided by the cost of capital minus growth rate is the amount. I should have put this NPV formula. So you take the NPV of the cash flow that grows forever. In this case, we got a 2% growth. Or you can get the same result as taking 500 years, 300 years, whatever, okay? And by just take 1 plus G divided by K minus G, or WACC minus G, okay? Or you can do it a little bit differently. You can make a little table, and this is where that wonderful dynamic array stuff does not work so well. I wish it, no, I don't really care. You take the initial book value, how much you've initially invested in a company, and that gives you an opening balance. And the return on equity, that's this 50, in this case I made it 15%. You earn 15% of your book value, that's what return on equity means. And then you put this dividend payout ratio, which is 1 minus G divided by ROIC, and you put that number in, and you get a closing book value because you get earnings, and then you take some of those out to go on your yacht, on everything else, and you get your closing value. That becomes your opening value, blah, 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 blah. And ultimately, the value of the shares over a long, long period is how this thing grows, this dividend. This is the money. Any valuation is pure cash flow. We'll talk about IRRs versus ROIs and return on invested capital and all that. And then you get the NPV. You notice I put that in. By the way, this formula, it's called formula text. Okay, you just put a little formula in Excel and you get that. In this case, we said the price of the shares was 42. We predicted 49. If we could forecast returns, if we knew what the cost of capital is, and we could forecast growth, we could do this kind of stuff forever. And now you can, then I said, screw this 500 years, that's crazy. Do the same kind of analysis, but make a terminal value. In your terminal value, you use the same formula. You notice I'm trying to do this without opening Excel, which is really pretty tricky, but these files are all on that website, and I think it's best to kind of go through that first. So this formula takes the earnings, 1 plus G, to adjust it for the growth, or you could take the next year earnings, which you don't have in here. So you take the earnings, and you take the earnings, and you earnings times 1 divided by G, 1 minus G over ROIC divided by K minus G. You get this as a function of what you think the long-term prospects for the return on equity are going to be. And I put, this time I said, we've got some different returns on equity in the future, in the past and the future, and we wanted to stabilize it. And maybe that's how we make a forecast, by really understanding what kind of return we can make relative to the cost of capital. And then we discount that cost of capital. So in this case, you've got some history, just like I showed you. You've got a little forecast. You make a little model of how much cash flow you're getting. You have this famous terminal value, which is most of the value here, because any corporation lasts forever. Now, I go crazy a little bit when I talk about project finance versus corporate finance. Coming up with a reasonable estimate of this terminal value is just crazy. Knowing what this cost of capital is crazy. Thinking you can project a return is crazy. Not understanding exactly all the biases and distortions in these returns are crazy. But it illustrates some of the problems. And in this case, all I showed you is a little bit how we made the graph. And in this case, we put the history with the returns and the forecast returns in here. And let me just show you some examples from that database I opened. In the database I opened here, I took Ibridola. I don't even know if I pronounced it correctly. Oh, they had some bad years, then they had some good years. This is the adjusted closing price. Whenever you look at, this is a wonderful thing about finance.yahoo.com. They have the stock price adjusted for dividends, and that's the only thing you can compare it. That's the relevant comparison. And the S&P index, by the way, doesn't have dividends. It's just such an irrelevant index, really. It really is. I've been using it forever, and it's okay to compute beta and all that, but when you look at the increase in the S&P, you really have to take account of the dividends. So what happened is they had some low returns and their price to book got low. In this case, the price to book got all the way down to about 1. The returns went up and the value went up and all of that, okay? Now, we can take this little model we did and make a little data table where we switch the cost of capital around and we switch the growth rate around and we switch the rate of return that we're making over long term. What I did here is used an interpolate function. I don't think anybody uses my interpolate function, but in this case, we said it gradually gets up to 15%. So we start with a history, it gradually gets up to 15%. And then we make a little data table that says, okay, what's the cost of capital and what's the rate of return? And when the cost of capital equals the rate of return, you get the same number, and that number is the book value. And that's such an important idea, and that's why I insist that if people are going to study corporate finance, they begin with this idea, and they don't. And in stupid MBA programs, they won't have you understand that when the price to book ratio is equal, when the cost of capital equals the rate of return, the price to book ratio is 1. It's such a totally important idea. And this is, now I have a growth rate, so I put a little spinner box around the growth rate. I've made too many other videos where you do this, you go back one sheet to the other. So if we increase the growth rate, if our cost of capital is 10 and our return is 6, if we increase the growth rate, the stock price goes down and the price to book goes down, not up. If you're earning more than your cost of capital, so if you're earning 10%, and your cost of capital is 6%, here's the price of the stock is 42. In this case, if it was 10 and 6 over here, it was 28. The growth rate matters if you earn more than the cost of capital, not less than the cost of capital. Everybody should know that. All right, and then I did the same thing with the low cost of capital, and the reverse happens. If you're getting out of a business when you're earning less than the cost of capital, that's basically all business, and you can demonstrate so much of the ideas of business with this basic kind of thing. Now, in that file I wanted to open with you, if you compare different companies, their return on equity on one scale and price to book on the other, and that's what you can get with that data, it's not a perfect line. It's certainly not a perfect line, but you get this line. This says when the price to book ratio is 1, we don't have companies that low really, then the cost of capital should be about 5. And that's the issue. And that's really what's happening here. This happens to take some utility companies who are relatively low risk. If we're up here, you're basically saying your cost of capital is higher than average. If you're down here, it's lower than average, but there are a whole bunch of changes in ROE and all that could affect this graph. Here's another thing where I took just a whole bunch of different companies like Southwest or McDonald's or Starbucks or Kraft or BMW or Volkswagen or BlackBerry or PayPal. I just tried a whole bunch of, and then of course you have much more variation because the cost of capital are different in different industries. Here are more international utility companies, and you do the same kind of thing. This time, because a lot of companies are in merchant and maybe, I don't know, have higher volatility for one reason or another, the implied cost of capital is 6%. What I'm doing there, I think, is dramatic, by the way. Okay, let's take an example here. Here's a company, Next Era, who's the biggest investor, at least in US, probably North America. They've got a utility company plus a renewable company. They're earning a return. Ooh, it goes up and down here. They've got a price to book ratio of 5 to 6 times. Their stock price, if you invested here, if you started investing right here, I can't even see the thing. Okay, I guess I started in 85. If you invested in the S&P 500 and collected dividends, it would be this blue line, and you would have made 9%, which is a gigantic return. Really big, really, really big. But if you invested in this boring company who kind of just has stable returns, they were a utility company and then got more and more into renewable energy, you would have earned 11.52. The difference between 11.52 and 9, it doesn't sound like it's that great, but over the long term, it's dramatic. And that demonstrates that if you don't understand how returns are compounded, you understand nothing about finance. Everything is about growth being compounded. Here's another thing, ExxonMobil, it's been earning high returns. Of course, when it was COVID and the oil price went to zero, it went way down. It earns higher returns, but it has a lower price to book ratio. So when all these goddamn, I can swear at them, these New York people who probably love one of those two presidential U.S. candidates, when they start yelling at Shell to get out of the renewable energy business and stay in the oil business because they want these high returns that they think they can get. Maybe they can get these high returns, but they're not giving the investors the real value. And you can start seeing this kind of stuff. If you invested in ExxonMobil way back here, you would have earned 4.92 compared to, it's a different starting point, so you have a different S&P value. And this is, again, when I try to do things differently, it's also depending on the growth. You know, this Elon Musk, he's the PayPal man. I think PayPal is the biggest ripoff ever. But PayPal's stock prices crashed when investors started seeing the growth rate of this company coming down. So they're making much return way, way above their cost of capital, and the growth rate has come down. Okay, and now I'm really going into this business of, let's all be here. All the consultants say, oh, here. And when you have a Harvard case study or say, oh, we're going to be here. We're going to be in this powerhouse square. And we're going to be in there forever, but you're never in there forever, because what really happens is everybody wants to get into this business, and you end up overspending here, and there's a bunch of surplus capital over here, and you still you've thrown your money away because your return goes really, really down, or especially if you keep growing, because you have this fantasy that you can grow when you're not making your cost of capital. I hope you can see this. I do this little simulation. The blue thing is the value, so if you can grow and which one is grow? This is have a high return and grow. Here's the size of the bubble mentions this. I kept the same cost of capital, which is really bad. When it's a circle, it's negative, so the risk is going down. I say it might be best to be here. Keep calm and carry on. At least get some positive values. And not go into these things where everybody competes. Let's show you some examples. Here's Amazon. Amazon's interesting. Their returns have been high. Their returns suddenly went down. They had this decline in share price, which really the same kind of thing happened in Amazon and Google and all these GAFAM companies. and suddenly we didn't know what's going to be their growth. Of course, they're earning way, way higher than their cost of capital, and on top of that, growing. Here's a different company, BlackBerry. Oh my God, everybody thought they were growing and going to be a powerhouse company. They've gone down to zero, of course. Here, the returns they were earning, and then their returns go down. So I'm just trying to show you some examples. For me, one of the most interesting examples of this is this company called First Solar, and the whole solar business. They were going to grow, and they were making a high rate of return and growing, and every investor would say, let's get into this company. They have some unique way to make solar panels, which are undifferentiable, not like Apple, where you can get addicted to those phones and pay twice as much as you would pay other companies. Now they've been able to come back. They've got into the EPC business, and so you can kind of see what's happening. And one thing we should know is that the growth rate goes down. Here's what happened to Apple's growth rate. So you just put this little ticker symbol in that file I showed you, and then you can get all of these kind of stories. Their growth rate over the whole period was 14%, 14.9, but over recent periods, 8 and 4. So they have this enormously high rate of return that Apple makes, but their growth is going down. Those are what we have to project. Okay, here's the PayPal changes in growth, and here's what happened to Elon Musk's great company. Okay, now I'm trying to, after thinking about these things for years, and most importantly, being able to go around the world and learn from people, I think this McKinsey book really sucks. I have read this book 4 or 5 times. The very first time I read it, I thought it was brilliant. And then I've gone down and down and down. They just worship high profits. They don't understand the biases really in the cost of capital, and they don't go through real world. They think you can compute the terminal value with some kind of formula instead of understanding what the real philosophy of the terminal value is, which is by the time you reach 500 years, and that's why I stuck 500 years in that little example, all of your assets are replaced, all of your people are replaced, and hopefully you've made people addicted into your name or something so much that you can keep earning a high return on capital. This is the kind of thing you do, and I really hate that this worship of high returns and monopoly profits is so great that they don't recognize the basic NPV rules. Here's what they say. In addition to higher returns in the United States, PE and market-to-book ratios have been significantly higher for U.S. Market when compared to Europe and Asian markets. Performance differences can explain much of the difference in valuation. In the case of return on capital, U.S. companies, consistently earn high returns on capital, higher returns than Asia. If you earn a higher return, great. That means you're charging a higher price. Good for you for being able to charge a higher price. Okay? What does that say? Does that say the companies are really that much better? This is the kind of thing they say. The median return is 19%, when we just saw the cost of capital was about, for particular companies, was about 5%. Oh my gosh. And Asian companies, they must be really shit. They only earn 8%. And this, I made some comments here, and I'm not going to go over all the comments here. Here's what I want to say. Pretend we have Shell Oil or somebody like that. Without renewable, their cost of capital is 7%. With renewable, they're only making a little bit on top of the cost of capital. Should they invest in renewable energy? Well, I think definitely, because that's increasing the value of the company. Without this, you'd experience, maybe I said you have a lower growth on all your oil business, and you want to get into the new kind of energy business. Maybe when you do all this, the price to book will go down, but the value of your company will go up. Here's what ExxonMobil, I don't find this these days, but I just took a lot of my old stuff. And what they say is, oh, here's what happens. In upstream, we're making 28%. Oh my God. When we go to other countries and rip them off, we're earning 13%. We're taking their oil and earning 31%. I just said 13% by accident. Oh my gosh. So let's put all our capital where we're making the most money and no capital when we're earning less money. Okay, great. But maybe you want to invest in some lower cost of capital activities. And here's what McKinsey claims, that all these returns go converge to down. And when you look at those real companies, you don't see anything like this. Look at real companies. Take that database I've made, put your own companies in that database, and try to look at actual companies rather than believing this complete rubbish. Okay, here's again, I put some boring companies. I think I opened this up. This company that had, oh my gosh, look at how boring they are. The returns on equity, oh, they're not making the kind of returns that these people say they can make. 19% return on invested capital, not on equity. Oh my gosh, but the price to book ratio is really high, higher than ExxonMobil. And that company, you would have earned 12%. You would have done a lot better than, well, yeah, a lot better than the S&P 500 when we adjust for the dividends. And here's the return on invested capital, and we could compute the price to book ratio like we do. Now, I think I am going to, let me see, just a minute. I'm going to stop. Because I need a break anyway, and I'm going to this is going to be part 2. This is part 1. If you can make it through that, we'll make part 2 and part 3 and some additional stuff. Okay?